Hi, everybody, and welcome to our first quarterly call of 2025. And thank you for joining us today. This call is being recorded, and for a reminder, you'll be able to find this recording on our website by clicking on the Resources tab and then clicking on Quarterly Investor Call. And before we get started today, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources believed to be reliable. The information in this presentation may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. Please visit our website or our YouTube channel to view a recording of this call or any of our previous calls.
Thank you, Carly, and Happy New Year to everybody on the call today, and for all of our listeners who are tuning into the recording. We ended the year in 2025 or 2024 with great results in the portfolio. So today we wanted to spend just a few minutes reflecting on where things are at in the portfolio as we look into 2025 and beyond. So Peter and Dominic will share some thoughts about that. And then we have a couple of things that we think are timely to discuss today that we wanted to drill into before we open the call up to Q&A. As a reminder, if at any point during this call you want to ask us a question about anything in our portfolio or what's going on in the market, the overall economy, you can use that chat feature to type in your question, and we will field those questions in the order that they are received. So our agenda today is to touch on a few of our investments, Fannie Mae, the common and preferred stock. We have an update that we haven't talked about that company in quite some time on one of these calls. And then Dominic and Peter are going to talk about some of the companies that we own in the financial services sector, BGC Group, M&T Bank, and AirCap. And then both Dominic and Peter took trips, research trips this year. So we'll have a little bit of discussion about Dom's trip out to California to visit our investment in 5 Point Holdings and Peter's trip to New York City to meet with the leadership team at Qualcomm. Before we advance into the slides, I guess, Peter, Dominic, why don't we start with Dom because he's unmuted here. Just share your reflections on 2024 and what you see looking ahead into this calendar year.
Sure. Thanks, Justin. 2024 was certainly an interesting year in the sense that it was a lot of the same, in the sense that your large cap, your dominant players, NVIDIA, Facebook, Meta, Amazon, they continue to gain share in all of their respective markets. And things starting today with JP Morgan as the largest bank continues to show why they're a dominant player in the banking space. So that was the interesting part of 2024, and so far to start 2025. And then for me, what I'm most optimistic coming into 2025 is over the past couple of years, the mergers and acquisition space, due to the previous administration blocking many mergers for seemingly not the greatest reasons. And with the new administration, I suspect that the opportunity for companies to consolidate certain industries that have been waiting to do so over the past couple of years, I think that's something that I would expect coming into 2025. And we own companies that are cheap and are doing fundamentally good things in their industries. And typically that's a very attractive setup to potentially see some acquisitions in the portfolio. I don't think something like that has happened in several years. So we'll see what happens in 2025.
Thanks, Dom. Pete, do you have any reflections and just share some optimistic thoughts about where things look ahead for 2025?
Sure. Our portfolio, we approach things from a very, very long-term standpoint. And it's exciting to watch the companies as they develop and they come to fruition at unusual ways and sometimes quite suddenly. But as Dominic mentioned, we're looking for things that are in the unloved and unwanted section of the markets. And it requires an awful lot of patience. And it clearly is very, very different from the way most financial advisory firms approach things. But it is the approach that makes the most sense to us. And we're going to follow that approach because our objective is to be responsible stewards of our clients' wealth. And this is the approach we believe is in their best interest.
Well, that's a nice tee up for the first subject that we have, speaking of being patient and shopping in the unloved and unwanted space. We've held our position in Fannie Mae, both the common stock and the preferred stock, for many years, and have been consistently adding to that. We recently saw a breakout in the share price. Dom, I think you can confirm, but it was our number one position in terms of returns in 2024 from a percentage standpoint. So maybe we could talk a little bit about what's going on with Fannie Mae post-election and what led to some of that sudden price uptick.
Yeah. So in the 2016 election, Trump, one of his main objectives was to get Fannie Mae out of its conservatorship due to obviously unforeseen things. It did not happen. The Biden administration did not put an emphasis on getting Fannie Mae out of it. And so the hope is that now that Trump is in and he is able to act on his agenda from day one, that Fannie Mae is finally in a position to exit conservatorship. And so what that would likely mean for the portfolio holdings of the preferreds, the most likely scenario for them is that they are going to get taken out at par, which is $25. And then the commons, we're going to have to see how much money Fannie Mae needs to raise in capital to get to certain equity level requirements that are required by different regulations. And so on 11/5, Trump wins and Fannie Mae, both the common and the preferreds, spike on the news. Again, renewed optimism that they're going to exit conservatorship. And then on 12/30, Bill Ackman, who's a high-profile hedge fund manager out of New York, he runs Pershing Square Capital Management. He's been a very long holder of both the commons and the preferreds, came out and said that Fannie Mae is one of his best ideas entering 2025. And he is very well connected with those in the incoming administration. And unsurprisingly, people follow him into his ideas. And then on 1/2, the Treasury Department and the FHFA amended the preferred stock purchase agreement, and they laid out a framework for getting Fannie Mae out of conservatorship. And then on 1/9, Sandra Thompson, who's the head of the FHFA, announced that she is stepping down, and now Trump will be able to appoint his own individual there. So again, all of this is good news. Again, time will tell if Fannie Mae actually is able to exit conservatorship, but certainly things are aligning that that's what's going to happen. So I will pass it over to Pete.
Sure. If we go back to our original investment thesis, it goes back all the way to 2009 when they went into conservatorship. And then in 2012, they made an amendment to that agreement, the loan agreement. And in that agreement, the government said, instead of paying us the 10% interest on your loan, on your outstanding balance, you don't need to pay us interest anymore. Just give us all your profits between now and perpetuity. And that was our main thesis, was that was illegal. And we believed that was going to be overturned. And so we began purchasing the preferred stock in 2023. This investment has taken much, much longer than we'd ever thought it would. We now are seeing some real improvements. Some of the things that happened they overturned, they had a new agreement and they allowed the Fannie Mae to start building capital in 2019, and that's now gone from about $3 billion in capital to over $80 billion. They're one of the most profitable businesses in the world, and so I've been very excited about this for a long time. So some of the documents that we've read and reread over the years that kind of give us our investment thesis of why we wanted to own this. One was the strategic plan from 22 to 26 that was put together by the Federal Home Loan Board. And then the Office of Management and Budget had a recapitalization plan in 2020. So those were some of the documents that kind of explain and give us the enthusiasm for the exit from conservatorship. The major question was, when would it happen? And certainly there's all kinds of political and legal ramifications with how to approach this. Also, for those who have an interest, there's two books that on Fannie Mae. One is Mark Calabra's book called Shelter from the Storm. I just completed that over the weekend. And he talks about his dealing with the COVID 2020 situation. And then also Timothy Howard, who was the CFO of Fannie Mae, did a wonderful job of describing the business and the political undertowings and such in the competition from the major banks in his book called The Mortgage Wars. For those who want to dig into this further, those are four documents two documents and two books that I would highly recommend and that I've read and reread and found invaluable in supporting our investment thesis.
Well, thanks, Pete and Dom, for giving us an update on Fannie Mae. I will make one small revision. Pete, you said we started purchasing Fannie Mae in 2023. It was 2013. I think the numbers just got transposed. So it's been a much longer haul than just the last year and a half. We've been in this thing for many of our investors for almost 10 years, and again have been buying it along the way in anticipation that what we deem to be unconstitutional would eventually be resolved.
Thanks, Justin.
Why don't we move into some of the other financial holdings that we have in the portfolio? We wanted to use this call as an opportunity to drill into some of those holdings. And Dom, I think you've separated those into interest rate sensitive investments, and you had targeted BGC, M&T, and AirCap,
Yep.
correct?
Correct. Yep. So I'll just first outline kind of what's happened over the last year. And this chart's of the US government 10-year bond. And I'm going to say all throughout 2024, the expectation was the Federal Reserve was going to cut interest rates, which they can control the short end of interest rates, the long end of interest rates. So the 10-year, the 30-year is by and large dictated by the growth outlook of the economy and inflation rates. And so all throughout 2024, people expected interest rates to come down. And what's interesting is basically the Fed started cutting interest rates for the first time on 9/18. And ever since they've started cutting rates, the long end of the curve, so the 10-year and the 30-year interest rates, have basically done nothing but go up. And so 9/18, they cut by 50 basis points. And then on 11, I believe it's on 11/7, sorry, the Fed cut another 25 basis points. And then on 12/18, they cut another 25 basis points. And then coming into the year, I believe the expectation for cuts was around 2 to 3 25 basis point cuts. And I will say a lot of the main Wall Street banks are now kind of walking back, and some are not expecting any at this point. And so the question is, how does one, fluctuating interest rates affect the portfolio, and two, what's the effect of higher interest rates on some of our portfolio holdings? And so BGC, one of the main ways they generate business is from the trading of interest rates. And this is people speculating on the direction of interest rates, banks or other corporations hedging the interest rate. And so when the direction of interest rates is more uncertain, people tend to hedge or trade more often. And what that means for BGC is when people trade more often, that means they get more trading revenue. And we have seen their business has been firing on all cylinders throughout 2024 and into 2025. And so their interest rate business represents about 30% of 2024 revenues. And again, when you have an uncertain interest rate path, then the trading environment is going to be very fruitful for a company like them. On the other side, you've got M&T Bank, who lends on the short and or I'm sorry, borrows on the short, lends on the long-term rates. And so just by and large, when rates are higher for them, they're able to lend out, whether it's mortgages, commercial real estate, they're lending out at higher interest rates, which is just going to translate to higher profits for them. AirCap is a bit of a different story. It's more on the supply side that higher interest rates affects them. So when airlines are looking to get planes, they have two ways of getting them. It's either through leasing it, which they would do so through AirCap, or they could go directly to Boeing or Airbus and buy a plane from them. When interest rates are higher, that means the cost to buy a plane from Airbus or Boeing is going to be significantly more. And so AirCap has an advantage where airlines are not going to be able to buy as many planes, and thus the demand for leasing is going to increase. You know, you add in the fact that Boeing and Airbus have significant supply problems, and the current market environment for AirCap is going to be very good for them for the foreseeable future.
Pete, do you have anything to add about these investments?
The only comment that I would like to add is, as we've talked about over the years, the major issue that we're trying to resolve as equity owners is inflation is something that we're trying to outpace with our investments, and interest rates, of course, we don't try to predict those, but there's an awful lot of talk about how low interest rates are, but in my opinion, they're really not low. They're not high. They're on the low end of historical interest rates. And I think as we have higher inflation, which I expect later in the decade, that we'll continue to see higher interest rates being charged. So I think it makes for an unfavorable situation for being a owner of various debt securities like U.S. Treasuries. But the businesses we own here, I think, will all benefit quite nicely from interest rates if they do rise, and expanding their margins.
I couldn't agree with you more on that point. So as we move into the next topic here for our prepared remarks, I'll just preface this by saying that both Dominick and Peter, I think last year was a record year for research trips for both Dom and Peter, in terms of the number of visits that they made and the number of management teams that they were able to sit down with. Dominick, you had the opportunity to go out and visit the properties that we own on one of your trips to California. We have Qualcomm up on the screen. I think I'm going to just move back to, let's see. Did you want to talk about Qualcomm first, or
Sure.
BGC?
Yeah, we'll talk about Qualcomm first.
Okay, so Pete, I'll give it to you to talk about Qualcomm, and then Dom will move into your trip out to California after that. So Pete, why don't you fill us in on what's going on with Qualcomm based on the trip you took out to the Investor Day?
Sure. Thanks, Justin. If we go back to our original understanding of the business, Qualcomm is one of the pioneers of the semiconductors used for cell phones. And they were at a very unique scenario in that the industry was moving in one direction, and they believed there was a better solution. And so they continued to focus on what we call the CDMA technology, and no other companies was working on it. And ultimately, the CDMA technology what became the preferred and the better technology for expanding the market. But what that did was that put Qualcomm in the driver's seat, and they owned a virtual monopoly on cellular communications, whether you use the CDMA technology or even purchase their semiconductors. If you didn't purchase their chips to run your phones, you had to pay them a licensing fee because they have more than 100,000 patents on various communication scenarios. So as it's developed, we are, as you know, are always looking for things that are in the unloved and unwanted space. And in 2017, clearly Qualcomm was in that space, and their stock price had dropped off dramatically because one of the last moves of the Obama administration was to begin an antitrust suit against Qualcomm, and Apple stopped paying royalties shortly thereafter. The Chinese company Huawei had stopped paying royalties, and 5G, which was going to add significantly to revenues, was several years away. So they were in a very, very tough spot. And things even got worse about a year after we acquired it, in that Judge Judy Koh in California in the antitrust suit made a ruling that not only are they a monopoly, but their business model is illegal. So it was quite the punch in the gut. That ruling was ultimately overturned. So if you think about it, we've been listening to the various calls from management now for over 8 years. And so we're very intimate with the business and stuff. So when we go to their meetings and stuff of that nature, much of the stuff is repetitive of things we already know. But one of the things they began is to look at is, since they totally dominated the cellular communication market, and the market ultimately started to flatten out in terms of its growth, they thought it would make sense to put money into research and development and to focus on some additional areas other than their telecommunication areas. And one of the areas that they began focusing on was automotive. And the automotive has, over the last 5 years, it's grown at a compound annual growth rate of 31%, but it is still a very small segment of the business. But it is going to become a significant portion of the business as we move forward over the next 5 years, in that they have a $45 billion backlog. And the automobile is no longer an automobile. It is now a computer on wheels. And so that's a very exciting space for them. Probably one of the more exciting aspects is that over the last 5 or 6 years, Qualcomm has been working with Microsoft and developing both what they call a neural processing unit for artificial intelligence computing, and they also have developed a computer processing unit and a graphics processing unit. So they have 3 stages of the semiconductor materials being used in computers. In June of this past year, Microsoft came out with their Copilot Plus Windows system, and of 16 manufacturers, in addition to Microsoft, were using Qualcomm's chips. That number has now grown to 58 companies. And so it's still in the very, very early stages, but we think that it's a very exciting area. Another exciting area that's in its early phases is in the what they call the XR area. And that's the made up of a number of different things, but it's really the virtual reality and artificial reality. And they have headsets that initially came out, and the market is dominated by the former Facebook or Meta in this area. And they most recently came out with these almost look like regular glasses, but they're an amazing device that is basically a pair of eyeglasses that is a computer. And you can ask it any question you want. You can ask it, what's your next appointment? You can ask it for directions. Or if you look at a plant, for example, and you say, what plant is this? The glasses will come back and give you an answer for that. So we're in the very early stages of that. But they are the dominant company in that relatively small market at this point in time. But one of the prognostications they said is in several years from now, very much like everyone has a cell phone, everyone is going to have these personal glasses as well. The area that they're putting a significant amount of money in research and development into right now, but has not shown any revenues yet, or they don't expect it to until over the next several years, is in the industrial space. We're excited about hearing about the products and things that they come out with in that area. Exactly what they are, I don't know, but I do know from listening to calls of NVIDIA as well that the industrial workspace over the next 10 years will be completely transformed from the world in which we've known it in the past. Everything from processing systems to robotics to to just the management of moving materials and things of that nature is going to have a dramatic change. So we have a company that's gone through an incredible transformation over the last 7 years and continues to invest heavily into research and development in both developing and in new areas. So very excited about Qualcomm and continue to feel very strong about our ownership there, and for clients that don't own it, adding, building upon that position as well. Justin?
Well, thanks for those comments, Peter. I'll also point to the fact that I believe it's tomorrow, you and Grace are going to be recording a little bit more of a deep dive into Qualcomm, and every couple of weeks, Dominick sends out a biweekly investment update email. So stay tuned. Peter and Grace will be spending even more time on Qualcomm. If you're curious to know more about that holding and what our thoughts are, Pete, you'll be discussing that in greater depth, and that'll get recorded and hosted on our website.
Correct.
Great. Dom, so we'll go back to you, and I'll, on the same note, before I kick it off to you, comment that you and Grace also did a recording about this trip out to California, and that has been shared and is live on our website. So for people who want to know more about 5 Point Holdings, that call was about 20 minutes. It'll go into more detail than Dom shares here. But Dom, why don't you give us some of your impressions from the trip out to California, and just let us know what you're thinking about 5 Point Holdings today.
Sure. Since I've been here, Pete has always said you don't truly understand the land that we own until you go out and see it. And you can look at Google Maps and Google Earth and see what it looks like, but until your boots on the ground there, it gives you a totally different perspective of what we own. So Valencia was one of the properties that I went to. It's located just, I believe, just north of Los Angeles, and the property itself, what shocked me was just like how hilly, how mountainous it was, and just how much work it takes to go from these hills to just your flat land so you can build houses and communities on them. Valencia is still very early in the stages of development. They had several parcels that looked like they're getting ready to put in the infrastructure, so roads, sewage, piping, things like that. So it's that property specifically still has many decades left worth of land to sell. And Great Park is basically the exact opposite, where it's almost completed. The land is incredibly flat because it was a former Air Force base. And the thing that I came away with was Great Park. It probably has 5 years left of land to sell, and the community it's one of the most desirable communities I've ever seen. I saw kids walking home from school. Everything looks safe. It looked clean. There's beautiful parks to walk around. And my takeaway was just, I can't imagine a family walking throughout Great Park and saying, no, this place is not for me. And so that should translate to higher land prices as they sell out the final couple hundred acres that they have left to sell. The next property I went to was Candlestick Park, and then right across the water is Hunters Point. Candlestick Park is the former San Francisco 49ers stadium, since been demolished. I would have said last year, if I had went last year, or in 2023, call it, I probably wouldn't have gone to the property, just because there was little hope that any progress was getting made on the development of it. And then throughout 2024 and the back half of 2024, a lot of progress has been made in terms of zoning and entitlements. That property looks like it's finally going to start getting some construction, some properties on it. Not 2025, probably not 2026, but maybe 2027 is when we can start to finally see tangible results at those properties. And then Hunters Point is a totally different story. That's still contaminated based on work done by the military. And so that property is, there's not much going on that property as it gets remediated. All in, my takeaway was the land is very attractive still. I can imagine Candlestick Park, the views that properties will have once that starts to get developed on the water are going to be stunning, and that should lead to high property values there. Great Park, as I said, the community is unbelievable. In Valencia, still has a lot of work to go, but we have decades worth of land there that, as it continues to get built out, land will become more and more valuable as people start to see what the community is going to look like when it's stabilized. So all in, continue to think it's a very attractive investment, and the stock is well below what we think it's worth.
Thanks, Dom. On the subject of Valencia, it's close, as you mentioned, to Los Angeles. Timely news coming out of Los Angeles with the fires. Can you just talk to the exposure Five Point has to those fires, and like what we've been hearing from the company this week?
Yeah, obviously devastating what's going on out there, and so far Valencia and all of Five Point's properties are safe. None of their properties have been affected. So the question is really going to be, how do the communities get rebuilt, and is there enough labor basically to not only rebuild the communities that have been destroyed by the fires, but then also continue to build out Valencia, Great Park, and the other properties that Five Point has. I think it's to be determined on what the progress there is. I still think the land is still in a very desirable area. There's not many other places to basically build a new house besides the properties that we own, just given what's already been sold in the past. So fire damage is more of what are the knock-on effects for Five Point than it is a direct impact to them.
Thank you. Pete, I know you're all intimately familiar with this business as well. Any additional comments to tack on to Dom's comments about Five Point?
Sure. One item that has transpired over the last several months is they had a commercial operation, and they've sold the remaining land to the City of Hope Cancer Center, and that transaction, I think we'll see the details of that at the end of the first quarter. So we're still several months away from seeing the result of that. But over the years, the new management team, which came in place about 2 or 3 years ago, has done a terrific job with making improvements and in reducing debt and making the company in stronger and stronger financial position, as well as owning some of the most desirable land in California.
Thank you. So I think that concludes our prepared remarks. We did get a couple of questions, and please feel welcome to submit additional questions for us to address here. But I will start with the first question that came in from Mary Ellen. The question is, Fannie Mae made nothing for 10 plus years. I think it's been, we're going into year 12 of owning this investment. Will our future return merit the decision to hold over this period of time? I'll take just a first crack at this, Dom and Peter, and you're welcome to elaborate. I've owned Fannie Mae myself during that entire period of time, and particularly with the preferred shares. I think if you look back at your cost basis, many of those shares were purchased between the price of $1 and $3. So if we use the high purchase price of $3 and we extrapolate that out over 11 years to get to that $25 takeout price that Dom referenced, that turns into a compound return annually of over 20%, which was far in excess of what we would deem as satisfactory. So yes, absolutely. The decision to hold over this period of time has been well worth it. The caveat there is it's still not a done deal. We still may have some more time. So our optimism and conviction in holding the investment is still high. I'll let Peter add to that if you have anything you'd want to add.
Sure. Fannie Mae as an investment has taken much, much longer than we ever anticipated. And for years and years, it showed losses of 50 and 60% on client statements. And so certainly disappointing from that perspective. I also viewed it kind of as owning a piece of land, and your feeling is that ultimately that piece of land is going to have some significant value, and you believe in your mind that that's the case. And so you're not focused on the short-term performance of it, but it certainly has taken much longer than I would have ever anticipated. In the year 2022, when the market was so volatile, there was a client that I was adding to their position in Fannie Mae, and I bought some of the common stock at $97 or 97 cents in March. And then 3 or 4 months later, purchased some additional shares at 66 cents. And then a few months later, bought shares at like 42 cents. And I think it went all the way down to 31 cents. So as a investor, it's been absolutely torture following this investment. But it's one we've always believed that there was significant value that would ultimately be recognized. I'm sure the return on that is not going to be as strong as if some of the other investments that we've made over the years. But anytime you have a portfolio of 25 or 30 different securities, you're going to have 25 or 30 different ultimate rates of return on your investment. So as I said, it's taken much longer than we'd ever anticipated. And by the way, we're not done with this. We still have several years of work that needs to be done to ultimately resolve this investment from our perspective.
Thanks, Pete. Next question, also submitted by Mary Ellen, is: it seems to me that land in California will take a big hit in many ways, including home insurance. So any comments you'd like to share about that statement?
I can take a crack. It's kind of similar to what we're seeing in Florida as well after the hurricanes. And I think even before these fires, there were insurance premiums were becoming an issue. I'm not sure if that is going to be enough of a deterrent. I think California is still, and whether it's LA, whether it's San Francisco, is still a very desirable location to live in. And the question is that demand going to override any of the external factors, whether it's insurance, whether it's getting the raw land there to build on? I think I think people are still going to want to live where they used to and still live in California. And one of the things that Pete and I have talked about a lot in the past is just California and the political environment there has been relatively challenging. And specifically, if we look at San Francisco for 5 Points properties, just getting that land rezoned and entitled to begin building on, maybe there's a chance that these fires could start to accelerate the potential change and make things easier to start building on versus the past, which has been an absolute nightmare. When I went out to California, I also met with the 5 Point management team, and they talked about how challenging it is to get the paperwork from start to finish out there. Sometimes you need a negative event to happen to accelerate change, and maybe that's what's on the horizon for us.
Thanks for that perspective. We haven't had any other questions come in, and we certainly can stick around for a few more minutes to give people time to ask any of those questions. During that time, Pete, is there any other comments that you might want to share with the group here today?
Sure. I would maybe add to Tom's response to Mary Ellen's question. Anytime you have a devastating event like we have had in Florida with hurricanes or in California with the wildfires, there's going to be things that are going to affect us, but you don't necessarily know how those are going to affect you until some of that stuff starts to happen. We have in California where there's people who are the builders. So there's going to be probably a tremendous demand for builders for both rebuilding in Los Angeles, as well as the building that's going on in Valencia and other areas with 5 Points. But some of that land and stuff may not be usable, and it may take several years to remediate that land before they can start rebuilding on that. In a case like that, that would be a tremendous boost for the land in Valencia. So there's always going to be some positive and negative effects that when the event is first hitting you, you're unsure of what those events are and how they're going to affect you. But I think when we look back a year from now, we'll be able to give you a whole bunch of facts of some of the things that had changed because of those wildfires. Everything from insurance to new regulations with how homes are built, to how close a home can be. So those are all incredible changes and that are going to happen somewhere in the future, but they're not really known to us at this point.
I'll add to that. And this was a conversation I had just recently with somebody. In terms of portfolio construction, you could very easily take a high level look and say you own stocks in your portfolio, and that's all the same thing. But the view that we have on diversification, I think the most important thing to keep in mind about that diversity is we want to own a basket of investments with decidedly different risks. And when we talk about any company, there's going to be risk factors associated with it. We just want those risk factors to be different from the other companies that we own in the portfolio. And certainly, the companies we've talked about today, they all share very unique risks of their own. They all have risk, but they are all diversified from the same risks that the other ones have. So it's a way to spread out that risk and own things with different risk profiles. Dom, I know you put a lot of thought into that. Do you have anything to add?
Yeah, I mean, that's kind of one of the things with Fannie Mae as well, right? Where that called bet is totally uncorrelated with the market and any other investment in the portfolio. So whether the market's up or down, it does not impact what is going on with Fannie Mae. And I think that was one of the real, it's obviously been a tough 12 years owning that, but I think that's one of the brighter spots of owning that security.
Agreed. Well, we've given people some time to think, and we had a couple of questions roll in here. Question comes from Steve. What do you think about the potential tariff impact on Green First? Dom, I'll give that one to you.
Yeah, I'm pretty sure it was Trump has talked about a 25% tariff to lumber imports from Canada. I'm going to say one thing. I don't know how much Trump is actually going to enact on what he is saying, whether he actually puts them in place or not, or if it's just a negotiating tactic. If they do put that on, all you're going to see is lumber go up probably by 25% or some significant amount, which is just going to end up costing U.S. homeowners more to build a house. I have a feeling that that tariff is just going to directly get passed on to customers. And what you're likely going to see is even more sawmill closures in Canada because there's still a lot of production that is on the higher end of the cost curve that may just come out as a result of that. I think the tariff is not what I'm worried about with Green First. Right now, there are duties in place where every time a lumber producer sells wood to the U.S., a Canadian lumber producer sells wood to the U.S., they have to pay a duty on it. And I think right now it's 8%. There's talk that it's going to go up to, I believe it's 25 or 30% in August. And they're still working through whether that is, what the final number is going to be. That is going to be a lot more impactful because there is already writing in place that some increase to duties is going to happen. And does that, again, what does that translate into? Is that more sawmill closures? Is that Canadian lumber mills don't export as much lumber into the US? I think that's more what I'm focused on, not the tariff number.
And naturally, if some of those are put in place, it affects companies like Weyerhaeuser on the opposite side from a positive perspective.
I was going to say the same thing. If the
Exactly.
price of lumber goes up, we also own one of the low-cost producers here in the United States with our position in Weyerhaeuser, and Weyerhaeuser would stand to benefit tremendously from higher lumber prices. So again, it's about constructing a diversified portfolio so that, there's unintended consequences with anything, tariffs, taxes, all of those things. But if you own companies that stand to benefit and some companies that may be hurt by that, what we're looking for is a balanced result. We did have another question come in from Keith. So this is for either of you, whoever wants to go first. Thoughts on the Trump administration being particularly impactful to any specific industries, maybe healthcare, energy, or is this simply justifying being diversified?
Do you want to start, Peter, or me?
Go ahead.
Okay. I guess so. The main thing that I've read, at least on the healthcare front, is just the ability for drug manufacturers to advertise on basically on TV and the impact that might have on the advertising market. We previously owned Warner Brothers Discovery. If you take off, I believe drug manufacturers are responsible for about 12% of ad spend per year. And if you take off 12% from a market, what does that do to whether it's Warner Brothers, Roku, Tegna, other companies that advertise on their platforms and generate the bulk of their revenue through advertising. That's one that I've thought about a lot, and continue to pay attention to what the regulation is going to be on that side. In terms of like the direct impact on any one specific industry, healthcare, energy, your guess is as good as mine. Just I don't have any firm insights into what his plan is actually going to be.
I would agree with your comments. I don't have any further comments on it.
We'll know more when that plan comes out, which I think we're looking forward to. In general, Dom, we've talked about this. Seems to be quite a bit of optimism out there.
Yep.
About the administration. So I think it was maybe it was in our investor forum in October that we made the comment that no matter who wins, there's going to be on one side more optimism than is probably justified, and on the other side more pessimism that is probably justified. At the end of the day, what drives the value of these businesses is the long-term results of the company. What happens in the short term is very, very tough to project. There's so many unknown factors. So we keep our focus on the long term and buying well-capitalized businesses that we can pay reasonable prices for. And then we keep our eye on management to make sure that they're doing the things that they said they would do. And right across the board, we've seen a number of management teams that we just have the utmost respect for continually deliver. And when they don't, we look to possibly exit our investment, and that's okay. Nobody bats 1,000 in this industry. But I'd say overall, we've done a pretty good job at aligning ourselves with people who take that same stewardship approach that we want to take with our clients' money. One other question has come in here, again from Steve. Is this the year for small mid-cap performance given the economy and other factors?
Small caps, I think, are the cheapest they've ever been relative to large caps. And I don't know what the number is. It might be 10 years, it might be 20 years. Certainly the valuations are not demanding. The outlook, as Justin just said, is very positive. I think today, it was either today or yesterday, small business confidence, there's like an index, it's a survey, and the confidence of small business owners is the highest it's ever been since I think it's 1983. People are optimistic about the economy. Small and mid-cap companies, whether you want to look at BGC, Donnelly, several other of our portfolios, there are a lot of tailwinds for their businesses entering 2025. Their valuations are very cheap. I thought 2024 was going to be the year of small caps, and it was again the year of the Mag 7. So I'm not going to say this is the year of small caps, but I think things are set up for them to perform well. But I'm not going to tell you that small caps are going to outperform large caps, because I thought that's what was going to happen last year, and it was decidedly not the case.
But typically, if when we're fishing for investments, the small cap and mid cap area are the ones where the better value is, and ultimately, over time, I think over the next 5 or 6, 7 years, you'll have better performance than in the large cap companies.
Yeah, I'll just add one other thing. If you look at how large the large companies are, right, there is only so much GDP, so much revenue out there for these guys to take. I don't know if we're coming up at the law of large numbers. NVIDIA continues to grow like a weed. The performance there is unbelievable. But, NVIDIA was up, what was it, Pete, 171% in 2024. It's a $3 trillion company. Like, the odds of it going from a $3 trillion to a $9 trillion company, probably relatively low, which, I think we own a lot of companies where there is a much higher chance of them, doubling over the next couple of years, just based on where they're trading at today.
I don't have the ability to share a chart with you on the screen, but for the person who asked that question, I will send you an email with a nice chart that just shows exactly what Dom's been talking about. That the disparity of price to earnings for small caps versus these mega cap stocks it's not the lowest it's ever been. You got to go back to 1999 for that, but we're getting close to that. And yes, I can send that out to everybody. What I'll do is I'll put that in our newsletter that comes out in a couple of weeks. I think that exhausts our time here for today. Carly, do you want to wrap things up? Thank you for everybody for the questions.
Yeah, thank you. So this ends our call for today. Thanks for joining us. And just as a reminder, for any of these future calls, you can send in your questions ahead of time if you would like. You can just respond to those emails that Justin sends out with the information about the calls, or you can email any member of our team. And thank you again for tuning into our commentary on the market and your investments. And you'll be receiving a recording of this call in an email, and you can also find it on our website within the next 24 hours. Thanks, everybody.
Thank you.
Have a great afternoon. Thank you.